Today, we've had gold backtrack just a little bit. That's this small red real body. But if you notice the low came just above about 25.20, and 25.20, of course, is that level that we earmarked as a technical level of resistance. And that's important. In terms of what I believe we could see, I still believe that we are in a motive wave, a impulse wave number 3. And I believe we could see a track to anywhere between 25.70 and 25.90. Possibly hitting 2,600.
Today, we observed gold's price movement with a small red candlestick, indicating a slight pullback. The price's low hovered just above $2,520, a key resistance level we previously identified. This level's significance suggests that the current trend could continue. I believe we are in the third impulse wave of a larger upward movement, with potential targets ranging between $2,570 and $2,590. And possibly reaching up to $2,600. Gary Wagner is a well-known financial analyst and trader, explains when analyzing silver, we see it trading within a well-defined range, making it easier to predict future movements. In contrast, gold is in uncharted territory, making forecasts more challenging. For gold, I used a basic Fibonacci extension, focusing on the current rally. By measuring from what I'm labeling as Wave 1 to Wave 3, a 1-to-1 extension suggests a target of $2,584, with the potential to move even higher. Recently, gold has been trading around $1,950 to $2,000 per ounce. According to Gary Wagner, in Elliott wave theory, Wave 4 is a corrective wave that will follow the current rally once it peaks. While a Fibonacci retracement can help identify potential correction levels, right now, we're firmly in a bullish rally. Moving averages are lagging indicators, but they're useful for identifying market trends. Gary Wagner, in an interview with Jeremy Safran, anchor at Kitco News, suggests that in a bullish market, the moving averages are tightly clustered, with the 200-day average, red, below the 100-day, blue, and both below the 50-day, green. This setup is called full bullish alignment. In a bearish alignment, the order reverses, with the 200-day moving above the others. According to the model, the current rally in gold might reach up to $2,600 before a correction occurs, potentially bringing prices down to around $2,515. After this correction, the fifth wave in the motive phase could drive prices to new record highs, possibly reaching $2,700 by the end of this year or the first quarter of next year. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
The thing about it is when we look at silver in a little bit, we're in a defined range. We've been there in terms of the highs as well as the lows. Mm-hmm. And with gold, it's not like that because we're trading in uncharted territory. So there are less tools that we have to use to forecast where we think the upside of gold is rather than silver. It's a lot more clear cut with silver. But all I've done is a basic Fibonacci extension. I've looked at this rally and I've taken the move from what I'm labeling as Wave 1 over to Wave 3. A 1-to-1 takes us to 25.84. And then these are possibilities of where it could go if it moves higher. A Wave 4 in Elliott wave is a corrective wave. So that's going to occur after this current rally runs its course. The market will correct and we'll look, there's different ways to look at where the correction could go. And typically you use Fibonacci retracement. But for right now, we're clearly embedded in a bullish rally. Of course, noise on any given day can move the market higher or lower. But as a whole, I would expect the market to continue to drift higher, at least for another $20 to $30, $35 before it begins to get overbought. When we're looking at the moving averages, realize that those are basically lagging indicators. So I've just put them up and you can see how tightly they are clustered together. In a bullish market, first of all, the green is the 50-day, blue is 100, long-term 200 is in red. in full bullish alignment, you have the lowest value, meaning the one that's sitting the lowest being the longest time period. So you've got the 200-day at the lowest value. That is under the 100-day. Both of those are under the 50-day. And that's what we call full bullish alignment. In a bearish alignment, it will reverse where you will get the 200-day above the 100. But really what you look for with those is, by definition, areas of support, or when they are above trading as potential for resistance. According to the model that I am using, we're going to see the rally go as high as maybe 26, but no higher. And then we're going to get somewhat of a correction. I'm plotting this at about 25.15, and it's going to be that fifth wave, the last wave in the motive phase, that will take it to the record highs that we hit this year and next year, which I believe could be as high as 2,700 by the end of this year, first quarter of next year.
Silver's all-time high was nearly $50 back in mid-2011. Unlike gold, which has set multiple new records, silver hasn't reached that peak again. After a prolonged correction similar to gold's, silver saw a significant move in 2020 and 2021, reaching around $30 to $32, which was a former support level. Recently, silver has shown strong performance, with support around $29.25 and the next resistance level at $30 per ounce. Currently, silver is trading between $23 and $25 per ounce. A key difference between silver and gold is that silver, while a precious metal, is heavily used in industry, leading to price fluctuations based on economic conditions. The recent green legislation, such as Biden's, has increased demand for silver in solar panels and electric vehicles. This has created distinct demand cycles for silver. However, similar to gold mining stocks, silver mining stocks have been lagging behind. Market participants have largely anticipated at least one rate cut, which is already reflected in pricing. If a second cut occurs, it could push gold higher more quickly. However, if the Fed doesn't cut rates in September, which is unlikely, resistance may emerge. The potential for 2 or 3 cuts hasn't been fully factored in, and this could significantly shift the momentum for both gold and silver. Let's now turn our attention to the video again.
I want to take in the all-time record highs, and of course that happened in the middle of 2011. Unlike gold, that has hit multiple record new price highs, new intraday highs, silver has never touched $50 once it hit that area. It had a long, protracted correction in the same way that gold did up until the end of 2015. But if we take it to where we are now, if we look at what happened back in 2020 and 2021, we had silver flirting with highs from $30 to $32. That also corresponds to a former level of support before it broke hard. And so now when I kind of move this chart up a little bit, and let's focus it. Once we hit 2275, we had the first of a higher high that came in since its deep correction. It really traded and flirted with just above $32, came down, and look at what it's done over the last 2 weeks. It has been performing very strongly. Right now, I'm looking at a support at just about $29.25. The next level of resistance is about $30 per ounce. There's a key difference in the fundamentals of silver and gold, in that silver is it's a precious metal, but it is highly used in industry. And because of that, it has ebbs and flows, peaks and valleys based upon the economic conditions that are in play. Secondly, with the green legislation that Biden passed, a lot of silver had to be used for solar, for electric cars, things of that nature. And because of that, it's had different cycles of demand. And one of the things that we've noticed is with the silver mining stocks is like the gold mining stocks, They have been lagging, but they really took off today also. How many rate cuts the Fed implements this year? It's widely expected that they're going to do a rate cut in September. The odds are that that will be a 0.25% cut. Now, the Fed meets 3 times until the end of the year, September, November, December. And the question is, will they follow that with another interest rate cut in December or November? Will they have 2 this year or 3 as they had planned a while ago? I personally believe that 2 cuts are likely. I think that we'll have more than one, and I'm not convinced they'll be as aggressive as to cut it 3 times. My sense is that market participants have largely factored in at least one rate cut. If we get the second one, that's going to move gold higher faster. Resistance would come if they, for example, didn't cut rates in September, which I believe is highly unlikely. That is pretty much baked into pricing. But after 0.25% cut, they haven't baked in the potential for 2 or 3. And that's what will change the momentum of gold and silver.
Gold and silver face unique market conditions, with gold exploring new highs and silver impacted by industrial demand. Upcoming Federal Reserve rate cuts will be crucial for both metals, influencing their future trends. Investors should watch these factors closely as they will shape gold and silver prices. This raises the question, what factors will determine the dynamics of gold and silver prices in the near future, and what can we expect at the end of 2024 and the beginning of 2025? We want to hear from you. Feel free to leave your thoughts in the comments. Give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.